Labour's new super tax plan could change property investing within SMSFs forever. Here's what you need to know.
There are things that we can't control. Let it happen how it is. We stay aware of it, we learn, and we stay vigilant, but we don't overthink about it.
In this episode of the Investing for Doctors podcast, we're joined by Rich Harvey and Munzurul Khan to break down exactly what's proposed and how it could impact doctors, high-income professionals, and investors using self-managed super funds to grow their portfolio. We also have a discussion about the economy and where things are heading with interest rate cuts as we approach the end of financial year.
I'm excited about the fact that we're going to be in this new phase of the property cycle. And if you look at the history of all interest rate cutting cycles, you see a significant rise in property prices. And that trend is just going to accelerate.
We cover what we feel would be coming in terms of interest rate cuts over the next 6 months, what this SMSF tax actually applies to, and how unrealized gains could affect your SMSF, why the calculation method is misunderstood and often worse in theory than reality, who should be generally concerned, and who's worrying too early, and how to future-proof your strategy in case this legislation becomes law. If you're building wealth through super, this is a critical episode because the rules of the game may be about to change. Without further ado, let's get into it. Hello, welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have two special guests with us today for a end of financial year sort of roundtable. And we're talking about some topical subjects. So I've here Mr. Rich Harvey from Propertybuyer. He's an economist by trade, but is the founder and CEO of Propertybuyer, one of the largest buyer's agents in Australia. And with me here, we have Mr. Munzurul Khan from KHI Partners. He's an accountant extraordinaire. And welcome, gentlemen.
Thank you.
Thanks, Ben.
Thank you.
Great
Thank
to
you.
be here.
Thank you.
Thank you. So today because we're approaching the end of financial year, so we're going to be talking about a couple of topical subjects, and it's going to be an interesting conversation. So I think the first thing of all that's very prominent in the media right now is the interest rate cuts that we'll be expecting. We had an interest rate cut in May, and which the majority of banks have passed that on, and I believe we're expecting another 3 interest rate cuts for the end of the year. Three more.
Yep, absolutely 3.
Yeah,
Yep.
yeah. So I guess to start off, Rich, how are you so confident that we're going to have 3?
I put my 3 fingers, mate. I'm just coming out of an operation. How many? Definitely.
Why 3?
Why 3? Well, I mean, if you look at the modelling, okay, look at the bond market and what it's all saying, and a couple of reasons. One, inflation's back in the Reserve Bank's comfortable band, 2 to 3%. Trimmed mean finally got within the band, 2.8, 2.9%, I think it was. Secondly, interest rate cuts or rises take around 12 to 18 months to flow through the economy. Okay, so there's a lag effect. And if you look at what's been happening, it's really had a dampening effect, which is the desired effect of interest rate rises. It's had a real drag on the economy. So people are spending less. It's reining in inflation. So that's a good thing in sense of bringing the market a bit. But it's also now tipped, it's pivoted, it's gone the other way. We've had the whole crazy Trump factor, the trade war, uncertainties globally. So the Reserve Bank has gone, you know what, we now need to stimulate the economy, therefore we're going to cut rates. So they don't do it. There was talk of a 0.5% cut, a supersized cut. That didn't happen. I was actually predicting a 0.35% cut. That didn't happen. That was my prediction, but it didn't happen. I thought they'd normalise the rate.
Because there was that
0.1. Yeah, they didn't go to 0.
That awkward 0.1%,
exactly, the last
isn't it?
rate cut.
Yeah.
So, but the money markets are predicting 3 rate cuts, I think, by December or February of next year. So, again, the Reserve Bank and all the bank economists are very reactive to current data, as they should be. They keep changing their forecasts because it's a dynamic environment that we're living in. But yeah, definitely we're going to see 3 rate cuts more, and that'll bring the cash rate down to about 3.1%, which means a mortgage rate of about 5%, which is great. So that's going to be really good for the property market in terms of stimulating demand, making lending more affordable. So you're going to see more buyers coming into the market, and hopefully you're going to see more vendors willing to have a go at selling their properties, and more trade and more turnover, which is what we need to see in the property market.
Yeah, awesome. Munzurul, is that,
Yes, no, absolutely.
Do you agree with that?
Absolutely. Everything which you say, I agree. And if we look through, right, because the challenge with the interest rate is that we always say that there is that science as well as there is this art, right? And science is the one that you ran through, which is, yes, we've got this Trump factor. We also have that inflation, which is sort of reasonably managed at this stage, and whether there would be another 2, 3, or arguably would be more. If we look through the different economists and the different bank, even the banks can't tend to exactly agree. So NAB seems to be a little bit more bullish.
Yeah, 2.85 there going
That's
for,
right.
Yeah.
NAB seems to
So
be
they're
a little-
predicting 4.
Yeah,
NAB seems to be a little bit more bullish, right? At a point of time, and when we say bullish, even on depending on when we see, if we look back to NAB about a couple of months ago, it was actually 2.6. So they've increased that to 2.85, right? And
I mean, that's not bullish. That's actually the opposite of bullish because they're predicting the economy to do worse.
Sure. So all those I agree, right? My personal view is that around that 3.1 as well, which seems logical, right? But at the same time is that when we bring in that art of that economy as opposed to the pure science, it's almost a butterfly effect, right? And it's a butterfly effect in the sense that someone doing it somewhere in here. So you look into the war as an example, right? So you've got the Donald Trump who's trying to fix everything in the world. And then if that war sort of escalates, then all of a sudden all the prediction that we change it. So there is a sense of still uncertainty, and even in the bond market seems to have slightly of a mixed message, mostly saying it is about 3.1%. Now what I take out of it is that if we look back in terms of our rental over the last 2 or 3 years, is that the rental market has really increased. Right. I mean, we used to say gone are the days that in Sydney you can get around 4.5% return. And whether the question is house with a granny flat, one can. So while we had that increase of the rent, and now we're getting that decrease of the interest rate, and what is that impact? And the impact is that it's a double impact in terms of the property.
Yeah. And I mean, rents in certain areas have definitely gone up tremendously. And
But the rate cuts, another point I'll make, is the rate cuts just bring more confidence back into the market.
Yes.
If you look at the consumer confidence measure that Westpac and Melbourne Institute do, it's been hovering around sort of 90 points or whatever, bumping around there. It was down as low as 80, which was back in the COVID days. But it just restores confidence.
Yeah.
And that's a really big thing for the property market.
Yeah.
Is people, even if they haven't received the rate cut yet, they now feel more confident to go and buy or confident to make a decision to sell.
And
with the expectation
exactly.
That's right. And
coming.
Rich, when that first interest rate dropped, that 0.25, when it dropped, right? We sort of always spoke is that first interest rate, while it is symbolic, the impact of it arguably is quite as strong.
Correct.
And it's a longer term impact. And the impact is not so much the immediate finance, but just knowing that, yes, that first rate drop means that, yes, we are in that right track in terms of the interest rate drop. So I agree. A second point is that what you also touched as well, that there is also a time delay in terms of where the interest rate drop as well as where the impact comes in. That time delay is that on mum and dad's hand in terms of when we see it, but there is also a time delay in terms of what is the property market in the ground as opposed to what is the property market that we're reading on the statistics, right? So there are a number of markets, as an example, that I hear from different buyers agents that they're so strong at the moment. But if you read the news sort of says that they're just about to increase, but they're not. They're a lot further.
I mean, these days, I don't think you can trust the news in anything, can we? So it sounds like we're in quite agreement that there's going to be about 3 interest rate cuts potentially coming through. How much of that is priced in because Trump is just doing all the crazy things he's doing versus just the fundamentals of the economy is not doing as well?
Well, it's a mixture of everything. I mean, I think world trade has a dramatic impact on Australia's fortunes. Absolutely. So, I mean, our main trading partner is China. We don't do a huge amount of trade. I think it's like 5% with the US. So, what the US does ripples across the world, but as a trading partner, not as important. But yeah, domestically, it does. It does an important impact. I think we need to. Our economy is pretty robust. I've got to say, it's pretty resilient. We're really adaptable to change, which is great.
Yeah.
We're a service-based economy primarily. We don't have a lot of manufacturing. We still have a lot of mining.
We have a lot of primary industry.
Yeah. But we're primarily a service-based industry, which is great. So we can pivot. But yeah, like we're not the lucky country as such, but we are in some ways, right? We've got to continue to be the smart country. And hopefully our politicians can guide us through whatever storms are in the future and be able to pivot quickly when international things happen, but really work on building those international trade relationships like he's doing with Indonesia, like he should be doing with China, really cementing that relationship, because that's critical to our fortunes.
Yeah. And, I see how the US has just pivoted so far away from their traditional, alliances these days. And that's just from so much uncertainty to the present day economy. But thankfully, Australia hasn't been affected too much because, yes, we're allies, but we're not really a major trading partner. Where do you see all that, shift from going from a, very unipolar world into a multipolar world, which is what we are heading into right now? Like, is this something that we should be bullish about, or we should be a bit conservative about as an economy or as a country?
I just say cautious optimism as always.
Optimism.
Yeah, I think we want to think that our trading partners and Australia is going to maintain some good relationships, but you got some things from left field. China could decide to invade Taiwan. Putin might never back down from. It might be a 10-year war. Who knows? All sorts of things could go on. Trump could actually really test his resolve and really push the bond market and see that the US credit rating drops to a B, which would be disastrous.
Yeah,
and China could call in its bonds. Who knows? That could really upset the world balance and create another world financial crisis. But what I know in all of this is that owning property during a crisis is a very good thing to happen. We all need a roof over our heads.
Yeah, absolutely.
I'm bringing it back from the macro to the micro fairly quickly, because we've got to do this. A lot of people panic and do nothing.
Yeah.
Right. But often, as Warren Buffett says, start getting greedy when the whole world falls apart. Right. Start getting smart, prepare yourselves for these things.
Yeah.
So what I'd say to any investor out there, have a cash buffer, make sure you've got offset accounts, make sure you've got all your investments in the right structures, so you can pivot and take advantage of these kind of times that may or may not come in the future.
Rich, the invisible hand that we speak very often, right? And we sort of say the invisible hand in the longer period of time, you will balance out everything, right? Because we speak about the opportunity. Opportunity means more demand, and more demand means that it sort of gets balanced out over a period of time. So I agree. I mean, this is exactly what we say to all of our clients. We say that there are certain things that we can control, and there are many things which are beyond our control. What is Donald Trump going to do? What is that bond market would be? Many of those things beyond our control, right? However, what is in our control is that we do the numbers as it is. Yes, we can look into another 2 or 3 cards, but we would still not count those 2 or 3 cards, right? We'll sort of say, as it is the market, that can I afford as it is on the market? Do I have a little bit of a buffer as such, right? What's the level of the funding that we can? And I agree that it is going against that trend in a very selective way. This is where you get your opportunistic buy.
I mean, even if the share market tanked, I go, great, good
time to buy.
Time to buy some more.
Yeah,
right?
So it's very interesting.
You look at just the whole share market versus property market. Everyone, like the number of people, there's not as many doomsayers out there today saying, "Oh, I'm waiting to buy when the market crashes." The property market's a Ponzi scheme. It's all going to collapse on itself. And I'm going,
it's not going to.
It's not going to happen.
It's the population growth, right? And sort of the demand in terms of that population growth sort of it. And sometimes we sort of compare, saying that, well, comparing to some of the other OECD countries, Australia is very expensive, our median price, and we look into some of those statistics saying that, well, at this point of time, it was only about 4 times, 5 times of sort of the family income, and the family income now 8 times, 10 times, 12 times. We've got to be careful with the this statistics as well.
I think I want to add to that is that back in the days where it was only single income, and now it's dual income families. So what's happened is that it's doubled because there's 2 income streams now.
Exactly is the point which I wanted to say, right? Is that one?
Sorry, I stole your thunder.
No, you're right. No, you're right. That's exactly what I was going to say, right? I was going to say that one got to be careful in terms of the statistics, not to just read the statistics as it is, to still understand the theory behind that statistics, right? And the things which had cultural change, so to speak. One is that this double income, right? And then also if we we look back to late 80s and early 90s, the whole banking system sort of changed, right?
Interest rates.
So we look through those sort of the monumental shifts, so to speak, and what is the next monumental shift? And we speak quite a bit in terms of technology, and I use that on a different terms in terms of efficiency, right? Whether we say technology, whether we say AI, whether we say efficiency, right? That is effectively is our monumental gain as such, right? And then I come back to that point is that all sort of the invisible hand, everything gets balanced out over a period of time as long as you're buying it, purchasing it on the underlying fundamentals.
I really like what you're saying there, Munzurul, because it's about being smart. This is where your wisdom comes down. I can see you talk the way you talk with clients. You kind of go, let's look into the future, but we're going to make our decision on the numbers today. Like we know the numbers are probably going to get better, but we're going to make sure we've got the right buffer in place. You can afford to buy it, and we're going to execute now. I like that. But back to your point about income, wage to property or wage to deposit, what do you call it? Property price versus income ratio, where it's 10 times income or 6 times. Every city's different. And I can't remember the numbers off the top of my head, but I think it's like 6 or 7 times for Adelaide and Melbourne and Brisbane. And I think it's 9 times income to get an average deposit to buy in Sydney. So that's pretty high numbers. So you've got to save up 9 years worth of income to get an average property in Sydney. Now, that's probably going to blow out. That's probably going to go to 10, 12, 15 in the next 10 years. So people keep asking me, Rich, how can property prices keep rising? It's ridiculous. It's so unaffordable. Well, the same conversation happened 20 years ago when I was buying my first place, or 26 years ago, right? Same conversation was happening, and they're just different set of numbers. They're harder, they're higher. I acknowledge that. But I think the point I want to make is that there's a lot of intergenerational wealth coming into play. So this is where the gap between those who are in the property market versus those that are never going to get into the property market, unfortunately, is going to continue to widen. So if you're one of those people that have great parents, unfortunately, they've been smart and bought a bunch of properties, you're halfway there, because hopefully your parents will be able to help you get a leg up. But even if you're not, even if you haven't got that parental help, getting onto the property ladder as soon as you possibly can is a smart way to go, because you can get into what we talked about in the other podcast, debt recycling. Using your equity to build your wealth is a great thing to do. And a point I'd make is that we look at the house price to income ratio and shudder and go, oh, I can never affordable. But turn it around. How can I afford it? What do I need to do to buy a house? And start getting aspirational. Like sometimes we hear all these things, it's all unaffordable. What can I do to actually make it affordable? Set a goal, set a dream, and go for it.
Yeah, I think there's always going to be the people who say it's unaffordable, and but I think the reality is it is getting less affordable. Not so much that it is. There will be people who are completely unaffordable, right? It's like, there will be people who can never afford to own their own home, and how do you sort of get to a stage where you can? And there's just so much white noise there. And I don't think that's really helpful in any sort of discussion to say, it's unaffordable. It's less affordable. We agree. But how do you do that? And how do you get in?
There's this author, Jan Somers, and Rich and I speak about Jan Somers. And Jan Somers, whenever someone speaks about Jan Somers, means we're a little bit older, right? The new generation is that whether they've even heard Jan, right? Jan, brilliant, right? Fantastic, brilliant. She only wrote 2 books. And I still remember, Rich, many years ago now, that I went into one of those seminars from Jan. Jan was actually presenting on the seminar, right? Many years ago. And what she did is that she came in with sort of a whole lot of a newspaper article all the way from late sort of 50s and sort of 60s and 70s.
The same complaints.
Right? And it was the same headline message, right? Property prices are so hard. It is out of control. Our next generation will never be able to afford it, right? It is just not affordable, right? OECD country compared with all of those, right? So all those messages, she showed that it went through generation to generation to generation to generation. And the comment which she was saying is that it is true. Property purchase is hard, and it's always was hard. It will stay hard. It will be hard in future. The question is that how do we still resolve it within that matter? And very often, it's your action taking.
Yeah, of course.
It's your action taking and goal oriented action taking.
Yeah, and the issue nowadays with social media, obviously individual voices get amplified, and that's just not a representative of the entire society or economy at that. And perhaps we are still not used to filtering out the excessive noise, where the loudest minority is perhaps have an overrepresentation because of the attention economy that social media has generated. All right.
I'd be very curious of hearing, Rich, what your view exactly on the question that you asked, because I agree with that question, right? Because we sort of see that there's so many sort of a new entrant, and sort of very often the reference point of a service provider is 3 years or 5 years or 7 years, right? And sometimes we don't know what we don't know, but that is what we know. And when we present this in the social media, as you said, in a very confident way, what is the impact, right, to sort of, I suppose, the inexperienced mind?
Well, it just disincentivizes people.
Yeah.
Like, that's the problem. Like, we sort of live on, 5-second Instagram scrolls and 10-second grabs in the media. Like, if you live your life that way, you're going to get lost, right?
Yeah.
I think I'm going to go back to my point before, is that you've got to eliminate the noise. You got to go, okay, the price is what the price is. Am I prepared to pay it? Otherwise, I'm going to be a renter all my life, right? So yeah, I think just get a clear head and don't make assumptions. Do your own research and set your own goals, run your own race. Yeah. You don't always have to compare yourself. Like, you don't have to live in Sydney. You don't have to live in Melbourne. You can live in a regional town. You know, and you can now, with remote working, whatever, you can set your own goals. You run your own rules, but don't always. A lot of people I see just make blanket statements. Property's unaffordable. I'll never achieve this. Well, that's a self-fulfilling prophecy, right?
Yeah.
So
and the Instagram generation is fueling that as well.
Yeah.
So it sounds like we're all very passionate about property, but let's keep going about the the things that are happening in our world today. The other thing that's very controversial right now is Labor's proposed legislation on the $3 million super cap about taxing superannuation assets above $3 million, even if they're unrealized capital gains.
Yes.
All right. Now, I'm going to just open the floor to, I can imagine what both of you are going to say, that it's a terrible idea. Let's start off with you, Rich, first.
I don't like the policy. I can understand why they're trying to do it. They're trying to tax those that they consider to have significant wealth or above average wealth, which is kind of a egalitarian socialist type policy, which I don't like.
I mean, is it above average? If
well, that's the thing. What's
less
average?
than 1 in 1,000 people are actually at that stage. So it's not average, right? It's like the top.
Yeah. So I don't like the policy. I don't think it's necessarily fair as such. But I'd love to hear from Munzurul. I would like to get the calculations right too about this, because I think there's a bit of conjecture around the calculations. So if you have I don't like unrealized gains, by the way. I think that's a terrible idea. Stupid and draconian policy. Because how the hell are you going to pay for it? You have to sell the asset.
And how are you going to calculate it?
And then you can't claim it back if the asset goes up and down in value. It's just so problematic. But I just think for the viewers, it'd be really good to get clarity on the calculation. So let's say, Munzurul, you've got an asset that's worth $3 million. It goes up in value by 500,000, say. Can you just crunch the numbers for me? Tell us what extra tax we're going to be paying, because at the moment you pay 15% tax, but once you go over the $3 million cap, you pay another 15%. So you're paying 30% tax. So if I've got a gain in my asset base of 500,000, what am I going to pay in tax the following year?
That's right. I mean, we take a little bit of a step back and sort of come back to the maths, right? So if we speak about the unrealized gain, and if we go back to the self-managed super fund, right, as opposed to the industry fund and sort of the retail, the rule applies to everyone. Right. Yeah. But if we go to the self-managed super fund, so you've got mom and dad investors in the self-managed super fund. They can be anywhere between 1 up to 6 members. Yeah. So mom and dad investors, what they do is that they go in the open world. They've got this fund. They use the leverage. They purchase the property. Yeah. And they may have multiple different investment properties. They've got shares, managed funds, and so. At the end of each financial year, the requirement is that from an accountant's point of view, is that we need to bring in the market value of each one of the member. So you've got the husband, you've got the wife, you've got 2 kids, so 4 members as an example, right? So we need to bring in the overall asset value of the group by going back to the market value, and then we need to allocate, saying that, well, the gentleman's share out of that, say, overall 5 million fund, Gentleman could be 2 mil, the wife could be, say, another 2 mil, and it could be 500 to the kids on the basis of various things, right? You sort of allocate that as such. So where you've got a total fund, you also have individual members fund.
Individual accounting, right?
Individual
Accounting by each
accounting fund,
individual.
right?
Yeah.
And then it gets audited by the auditor. Then the auditor is restricted in the sense that the auditor's restriction is that it has to be the market value. And why it has to be the market value? The auditor's logic is that the asset needs to be allocated in the right pro rata in between the different level of different your members as such, right? So auditor needs the asset value to be market value. The accountant prepares the market value. How do we get the market value? So property side of it, as an example, we can get a valuation, we can get an indication as such. So we have that valuation, right? But the point which Rich says, which is 100% right, is that let's say this is what my asset value is. Asset value has now increased that much. This is the unrealized value increase, right? Unrealized value in the sense that my 3 million has gone up to 3.5, but I haven't actually received any cash. It's a paper increase as such, right?
But Munzurul, before we go down, in the example you've given, husband, wife, 2 million, 2 million, 2 kids, $500,000 each.
Yeah.
They're not going to be affected by this.
On that example.
Because it's 3 million per individual,
absolutely,
not the size of the whole SMSF.
Absolutely, on that example. Beautiful. But roll forward that, right? Roll forward that 2 million of the husband and 2 million of the wife. Couple of things happened. Bit more contribution came in. It gone up to 2.9 mil, and 2.9 mil is the real value. So now I sort of come in and I sort of say, all right, we do all of those different maths, and the value has now gone up to 3.5, right? But the actual value is 2.9 mil, right? So on that example, what the government is proposing is that yes, we'll leave that tax rate within that sort of rate of 15%, and any incremental behind it, it goes down to 30%.
So that's above 2.9 million.
At 3 million.
Oh, sorry,
about 3 million is that you pay
million.
that 30%. What's the logic behind it? And do I agree? I disagree, right? But what's the logic? The logic behind it is that, number one, is that the government sees that as a bit of a money pot, right? It's sort of, how do we bring it in? Now, government tried to bring in that socialism vibe, saying that, well, this is where we balancing it out in between the wealthy generation, whether you call the baby boomers, and sort of the new generation to coming in. The government also utilizes the argument saying that, guys, if you are over $3 million, you probably would be at the highest marginal rate. Means that you would probably be paying 47% tax. So while we're increasing your rate from 15 to 30%, you still are arguably receiving a discount from that 47%. That's their argument, right?
And this is the same rationale for the Division 293 tax.
That's
on
right.
superannuation.
Absolutely, mate. Absolutely, exactly. So now I'm going to come back and say whether I agree or not, and I don't, right? But that is the justification from the government side of it, saying that this is where we balance it out, take it from the rich, share that with the poor, and sort of you already getting a adjusted benefit. This is, in their mind, is sort of as fair way as it can be. Do I agree with this? No. Do I see some level of logic? I probably do. However, the devil is on the detail, right?
Yes.
And devil of the detail is that the unrealized gains, right? I mean, to start with, residential property as an example, that you don't need to do a proper valuation. You do an estimated, you do a market evaluation as such. Once in every 3 years, you need to do a proper valuation. So there is a subjectivity attached to it. Second of it is the price also goes up, price also goes down, right? And of course, it's the unrealized gain as such, right? So the maths behind it is that on that example is that up to 3 mil is 15%, and anything over that 3 mil, you pay that additional 15%. So one does 500,000 with sort of 0.15, so you're paying that extra amount of the tax.
So, but the actual gain though, like if you
get taxed 30% on the gain?
Is it 30% or is it 30% of 25% as a capital gains tax? Like, what's the actual number that this person's going to pay? Because if you were to sell the asset and you've held for more than 12 months, you get a discount on your capital gains, right?
Good
so you
question.
only pay 25% tax, is that right?
Well, no, you pay in super, it's 15%, and if you held it for more than 12 months, it's 10%. But then now at the 30%, is that going to be?
Good question.
Well,
Let's break it down.
This is what I'm trying to get the number out of.
I don't think anyone knows.
No.
Do we know?
Let's break it down. Let's break it down, right? When we speak about the tax side of it, there's two taxes. One is the earning tax,
Yes.
and second is the tax on the capital gains.
Okay, yeah.
Right. So we look into the earning tax
Earning
first.
tax, yeah.
The earning tax means that anything which is up to that 3 million asset base is that whatever you're earning is that you're paying only 15% tax, right? Anything over that 3 million, you pay an additional 15% tax. So you
And is
pay
that pro
30%.
rata? Is that pro rata?
Only on the earnings.
Yeah,
Is that
not
pro
not
rata?
on the actual increase in the
No,
value?
only on the earnings.
Only on the
right.
earnings.
So let's say, as an example, if we do a random numbers, let's just say that overall your asset base has earned about $100,000 income. Then I, as an accountant, I need to sit down and prorata that the $100,000 income. 500 against 3.5 mil is about 1/7, so roughly about 14-15%.
Yeah.
Okay.
So,
So
on
that's
that example,
prorated.
that's right. So on that example, that 14-15% of 100,000 will be taxed at 30%, and the rest of the 85% would be taxed at 15% first.
Can I just put a comment here? I don't think that is a terrible thing from a operational perspective. I agree. I mean, the unrealized capital gains, that's another whole can of worms.
I want to come back to it. That terrible. I hear you. Allow me just that second part of it.
Sure.
That's in terms of the earning side of it, right? Now, when you sell it, of course, everything is being realized, right? It's actually being realized. And when it's being realized is that this is the amount that we receive in our hand. And this is where it becomes the capital gain tax. Your capital gain tax is a very simple 15% is the tax. And if you hold that property for more than 12 months, you get 1/3 of a discount.
10%.
It comes back to 10% after the retirement based on the balances that you have. There may not be any tax, right? So this whole tax is the unrealized gains and the income that you earn.
So can I ask you now, if you were at 3.5 million and you sold $500,000 worth of shares, that becomes cash, right?
Good question.
And then you have, say, 100,000 of capital gains. Is that capital gains taxed at 30% with the 1/3 discount, or is that taxed at 15% with the 1/3 discount?
Good question. We need to go back. Good question, right? Once you sold it, is that whatever the capital gain that you sort of make, you pay the normal capital gain tax rate. Yeah.
Okay, so the additional 15% doesn't apply to that.
That's the normal 15%. However, then you go back and you sort of say, well, what is my the disbursement? Yeah. And that when you sort of say I'm selling that $500,000 as a sort of a gain, right? In your book, that asset base could have been 1.1 mil as an example, let's say, right? So if it's a 1.1 mil, you actually sold it for 500,000. Number one, you haven't paid any tax because it's a capital loss. But also what that does on that example, it brings you down below that $3 million as well. So it gets adjusted. So you can see it gets very complex and it's sort of almost at a level that it's sort of opening up for adjustment, manipulation, playing with it with a mindset which arguably says that perhaps was not the worst of the mindset. It's a balancing of it, but it's the method behind it. Unrealized is always problematic.
Yeah, and this is before we even talk about unrealized. This is all realized, right?
Yes. On this
so then the unrealized, back to Rich example. So if we went from 3 million to 3.5 million, you have $500,000 of unrealized gain. Does that mean you're automatically going to get a 30% tax on the $500,000?
On the income side of it, right? Because
only on the income.
We look into two sides. Is that the tax we say one is on the earning, and the second tax is
let's ignore the earning for now. Your value has gone up by $500,000, or say let's go from say 4 million to 5 million.
Yep.
Right. We've gained $1 million of capital gains.
Yes.
And are we getting taxed 30% on that unrealized capital gain of $1 million?
No, what we do is that on the good question, stay with me on this. So you've got a 3 million, it's gone up to 4 million, right?
Yeah.
Then what I need to do as an accountant, I got to say out of that $4 million asset base that I have, what was my earning behind it? And let's just assume for a moment that out of that 4 million, I'm getting a 5% return. So I've got a 200,000 income, right? I got to go back and do a prorata on that 200,000 saying that 3 out of 4 million, which is 3/4 of it.
75%.
That means 75% would be taxed at 15%, and the rest of the 25% would be taxed at 30%.
Got it.
Complex.
Yeah.
Because there was
But
an
that's
article.
the earning. So you're only getting taxed on earning. You're not actually getting taxed at your
Unrealized.
asset level.
No.
Okay, so is that different from what That's quite different from what my understanding of that.
Yeah.
That's why I wanted to get him to explain it. That's the thing.
Yeah.
There was a good article in the Fin Review that talked about that exact point, and they talked about it's 25% of the 30%.
Yes.
So it's not. It looks really bad. I mean, but still, it's very complicated just from a calculation point of view. But also the potential for people to have weird behaviours about taking assets in and out of super and all. What's that going to create?
Yeah.
And the whole sort of a fundamental to our tax law is that we get taxed when something is being realized, whether it's from a capital gains, whether it's not. Whereas this goes against that principle.
So the value, the value is only on it's the prorated value. It's okay. So I think there are some people who actually think that whatever money that goes above it, they're gonna get taxed the unrealized gain
on the capital
on
gain.
the capital gains.
It's on the
Some
earnings.
people are talking about that.
That's the important distinction to make.
No
Exactly. And that
capital
was
gains
very good to clarify that it's not on that. So then back to your example, Munzurul, is that the proportion of the earnings that you're deriving can fluctuate based on the valuation.
Absolutely.
Okay.
Based on the fluctuation, based on what sort of sources that you sort of relied on.
On the value.
Because you haven't actually done a real valuation. It doesn't need to be done every year.
Yeah.
Even if you do a real valuation, that's still subjective.
Yeah. And then who is the arbiter of who is the right person for a valuer? Who is the independent valuer? Because you can play games there too, right?
Yeah, like what the
They
commission...
need to be a registered valuer and accredited valuer. That's reasonable, as long as they're a registered valuer. Because, like, again, you can get a val that can be $200,000 to $300,000 apart at that sort of level. So, but you got to have justified on comparable sales and asset values.
And Rich, where the challenge is sort of coming in is that I look back into my average client quite easily have number of investment properties on their super fund, right? And when that valuation sort of comes in and ATO is sort of moving, commercial property as an example needs to be valued every year now. Yeah. And residential property, they're progressively moving into valuing every year. So just imagine having to pay $300, $500, $900 times that by 2 or 3 or 5 every year. The cost adds up.
I think we're going to need more valuers.
Or automated way of doing that.
And don't trust the automated vals. Don't trust the automated vals.
No, I never know. I mean, I'm just
Registered
AI, right?
registered valuer.
Yeah. So okay, so that's good to clarify what that actually means, because I think there's a lot of people who are thinking it's a lot worse than it actually is.
I guess a point I'd like to make, if I can jump in there, I think even if this legislation hasn't been enacted, it's been proposed.
Yes.
I think it's going to take at least another year for it to get through the House in terms of the debate, because of the complexities we've just talked about. Second thing I'd say is that it shouldn't deter people from buying properties in a self-managed super fund. I still think it's a fantastic thing to do.
Oh, absolutely.
So I think even though there's a lot of people go, I don't know what I should do, I think I'll just wait. The dust will take a long time to settle. Don't let that stop you from buying a good property in self-managed super and getting your retirement funds going.
Okay, I think the critical question I want to ask is that do parliamentarians get an exemption from this?
That's a good question. Yes.
Like they did with 293,
At this stage, there's no publication in terms of the exemption, but it hasn't become law, right? The other thing which we haven't included is that this whole thing also doesn't get indexed. So when we say 3 mil, it's a 3 mil. Under the current proposition, it just stays at 3 mil, which is
it's crazy.
I think that's the scary part. But at the same time, our tax brackets are also not indexed, and
that's right. It's the I think tax creeping, as we call
exactly. And as much as I hate some of the policies, it's like there's a precedence for it. And so they just use that, there's a precedence for it. So this is the way we do things in Australia. And it's like a hand-waving gesture. Because if you actually look at the numbers, in 20 years' time with inflation and everything, 3 million, it's going to hit a lot more people than it currently hits. So if it's not indexed, then we have a problem.
Exactly.
And then the question is, who indexes it? And when does that happen? And it's just subjecting super to a huge amount of legislative risks. And this is something that I used to talk about. It's like you cannot negate legislative risk in investment decisions. And you don't think too much about it because there's not much you can do.
Yeah.
But just be aware that they exist.
Be where the pragmatism comes in and where the perspective comes in. And the perspective in the sense that when we speak 3 million, is that 3 million is still quite substantial
big
per
amount.
member, right?
Per member,
So
yeah.
I'm sort of getting question of sort of mum and dad investors who sort of hardly has about 400, 500, 600,000. They're beginning investors. We get it, whether there is a superannuation fund, and they're very, very concerned about this 3 mil. And what my sort of the recommendation is that it's just so far away.
Yeah.
So many things will change within that period of time.
Yeah.
Under the current rule is that after the retirement, there is no tax when you're selling it. And I've been saying this for years and years and years. I would not be surprised at some point of time if that gets changed.
Oh, absolutely. And this is my point. I was like, super is great right now, but it is open to so many potential legislative things that it could be a completely different by the time we get to retirement. That's assuming they don't change the retirement age, amongst a few other things. I mean, we have seen successive governments raise super for whatever policy of the day.
Based on all the technicality of this thing, I think there's going to be so much mental health that you'll be required to work into your 75, and accountants doing the tax returns till 90. So you guys have got a long road ahead of you.
I suspect we're all going to be replaced by robots, and everyone will be on universal basic income, and everyone's the same. Welcome to communism dystopia.
Yes. Sorry, I had to throw that one in.
Yeah, no, it's like it's one of these things, right? You don't know, but be aware that they exist, but don't be so fearful that it stops you from doing
Don't
it.
overthink it.
Don't overthink it.
And bring it back to your perspective. It goes back to, again, the point, there are things that we can't control. Let it happen how it is. We stay aware of it, we learn, and we stay vigilant, but we don't overthink about it, right? We don't overthink about it. We still sort of say, we've started our journey, we continue our journey as is.
Yeah. Like, to be very honest, I think a lot of people actually think when they say tax on unrealized gain, it means that people are going to tax the unrealized gain. As in, i.e., I've now gone from 3 million to 4 million, and we're going to put a 30% tax. So you have to pay $300,000.
The word capital gain is what they're in their mind. That's what the perception is.
Exactly.
As Munzurul correctly points out, it's the earnings.
It's the earnings from that. You use your valuation of your unrealized value. I think it's there needs to be a reframing of the language, right? So that's why I think, this is my personal belief, because initially when I look at it, it's like, what? They're going to tax me on my asset and not on my earnings? That is ludicrous. And then I looked into it, it's like, oh, it's actually just the unrealized value, not the unrealized capital gain. They're not taxing unrealized capital gain.
No.
They're adding an extra 15% on the earnings from the additional value.
They certainly haven't sold the policy.
They sold it terribly. I think they've sold it terribly.
Haven't even explained it.
I think they've sold it terribly. And but at the same, it feels like they just say, oh, it affects 0.1% of the richest Australians. So don't worry about it. Nobody's going to really complain about it. And it's and to be honest, it is politically it's smart, right? We want to win elections. This is how you play class warfare.
Yeah, exactly.
100%. And they have won by a landslide, so they have a mandate now.
And we again come back with the disclaimer, if I may, is that nothing has been 100% formulated as yet.
Exactly.
Right? It's still in discussion, and
it's not legislation
it can change
yet.
And it can adjust. It can, many things can happen. But as it is now, this is what the government is suggesting.
Through. My prediction, it'll probably get through with indexation. That's what I think.
The indexation is the
so
one
important.
I agree with you. That's the killer, right? And yes, I agree.
And then my question to that will be, which index are they going to use?
Well, I reckon they should use the Dr. B index. You just make it up, right?
Like it.
Yeah, I mean, that's another question, right? Which indexation formula do they use? Do they use the GIC rate? Do they use and then it's going to end up with a huge debate about what is actual inflation, what is, indexation, all that other things. Yeah. But I think that's beyond, that's too much for today. So it sounds like it's a not a great policy, but it's still something that the Australian public voted for, obviously. So we'll just have to see what actually gets passed and take stock of the situation from there. But
that's right.
So before the end of financial year, any other things you're looking forward to apart from, the next, hopefully 3 interest rate cuts, and what keeps you up at night, and what are you excited about? Rich?
Oh, what I'm excited about?
Yeah.
Going on holidays just before the end of financial year.
Going
over to WA to see my son. So I'm looking forward to that.
Beautiful.
Having a couple of weeks off.
Beautiful.
What I'm excited about? Oh, look, I'm excited about the fact that we're going to be in this new phase of the property cycle. Like everyone talks about growth, right?
Yeah.
So we've had interest rate rises. Now we're in an interest rate cutting cycle. And if you look at the history of all interest rate cutting cycles, you see a significant rise in property prices.
Yep.
So my prediction, it'll be a 15 to 20% over the next 2 years.
Really?
In most markets. Again, you just look at the core logic numbers for the last couple of months, every capital city is positive, right? And that trend is just going to accelerate. So I'm excited about that. So that's why I'm rapidly trying to get pre-approval to buy another property, right? So I'm excited about it. What keeps me up at night? Just balancing the books. It's always a challenge to, manage your portfolio and manage your business to make sure it's all humming along. And, for us, we just want to make sure we're servicing our clients 110% well. But no, nothing really keeps me majorly.
Socialism.
Yeah. I mean, as Munzurul said, you can't control what you can't control.
No. Yeah.
You got to wake up in the morning and have a positive outlook. Honestly, we are so blessed in this country. We should be super grateful for everything we have. So I think, we've got a glass very, very full and not half full. So let's celebrate that.
Awesome.
Beautiful.
And Munzurul?
I think from my point of view is that if we look through all the different commentators at the moment, there is a strong conversation that whether it is in the property super cycle is on the way, right? I utilize the analogy of 7 to 10 years, that whether something property doubles over 7 to 10 years, there's no one rule, right? It depends on which area and where you buy, how you buy and so forth. But if we say around, say, 7 to 10 years that it doubles, it doesn't increase exactly on the same average rate every year.
No.
You almost break down that whole cycle, whatever that beginning and the end of that cycle, into 3 small cycles. You've got this one part of the cycle where you've got quite exponential growth. Then you've got this second sub-cycle where its price gets slightly adjusted. Then you've got this third cycle, which is quite stagnation. Right, and the combination of those 3 is our cycle, right? Is rapid growth, slight adjustments, whole bunch of a stagnation, and then we go into the rapid growth again. So that's what the history tells us. Now, where I'm excited is that I think we are at the verge of that rapid growth. And that verge of the rapid growth is the one that where most amount of the gain comes in. We speak about time in the market as opposed to the timing, and we say that, it's the time in the market which does a whole lot of things. But if there is a timing of the property market, this is a good timing of the property market. Then we go down a little bit deeper and we say, well, again, state by state is different, right? That property clock, if we refer back to it, we say that, well, Melbourne is in a different place as opposed to, say, Perth, as an example, and whether Sydney is sitting somewhere, and you've got Brisbane. Now, what excites me? It excites me is that there is a whole lot of a mechanism which we're all building for property price to really increase, and I think that journey has just started. What keeps me at night? I suppose it's still staying conservative, in the sense that measured conservative is to say that what goes up, there is always a risk that at a point of time may go down. What goes down, there is always a risk at a point of time it still go up. Interest rate will decrease, But as an investor side of it, this is where I would be watchful, is to say, do you still have enough mitigation? What happens if the interest rate does drop at a point of time, it goes up by another 1% or so? Can you still afford to do that, right? It's almost to learn with all the trauma which we went through in the last 2 or 3 years with that high interest rate where we have given away all of our savings, and to learn from it and say that in the next cycle, we make sure that we don't over leverage. It's the balance is what I'm after.
And absolutely, that's learn from the lessons of the last couple of years with COVID, with Russia, Ukraine, and with the Trump cycle now. It's like anything goes, isn't it?
A Trump cycle, it's a Trump circle. Right?
Well, maybe he'll seek re-election in another 3 years. I guess I got to answer my questions. I'm excited that interest rates are coming down. Absolutely, because that's going to stimulate investment and progress in Australia again. I'm also quite excited that we're going to have stability in government, because it feels like Labour are going to be strongly in play for another number of years. Whether that's good or bad, stability, I think.
Stability gives
helps.
confidence, doesn't it?
Gives
Which
confidence.
is a good
Sure.
thing. Yeah, even if you don't like the policy.
You don't like the policy, but because you can work with the
work with
policy,
it,
Sure.
right?
Good point.
I think that's something I'm excited about. What keeps me up at night? I don't know, my kids. I'm generally quite bullish. I mean, I think the other things that really keep me up at night is really things that I can't control, and knowing that I may have to react to the situation in the US, the shift to a multipolar world. Is the US dollar gonna be further, what do you call it, change from AA1 to something even less than that? And then the bond market is actually quite scary, but I think a lot of people don't realize how scary it is. So maybe we shouldn't.
The world will go on.
The world will go on. The world will go on.
In a different format.
In a different format.
Really
There'll be
nice.
some pains. And I think it's really about my kids. I think I'm not sure what kind of world they're going to grow up in. I think that's the stuff that keeps me up at night. But
They've got a good dad, don't worry, mate.
oh, well, yeah, you got to shield them from it. All right. All right, gentlemen. Thank you. And we look forward to seeing both of you in the new financial year.
Thank you very much. Thank you,
Thank
B.
you, B.
Thank you very
Thank
much.
you for coming.
Thank you.
Thank you.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.